And we're just very big on giving away valuable information, helping, teaching, and any way we can help you to stay organized, updated, and protected with your planning is important to us. And we know there always are going to be questions that come up on these webinars. And if you want to get one-on-one with us, I'm going to show you how to do that at the end of this talk here. But we have a complimentary assessment we'll do for anybody, whether your issue is small, medium, or large, it doesn't matter. Estate planning, asset protection, business planning. Maybe you're just getting started, you have questions on your current planning, happy to help and give you complimentary input from our expert, getting one-on-one with Craig and the attorneys at the firm. And so we're going to jump into this. This is a very important discussion about estate taxes and what is actually taxed. And we want to dive into some detail on that. And so let me share my screen so you can follow along with what we want to talk about. Okay. Craig, do I have the slide up there?
I've got the slide on my side.
Great. Okay. So what we want to get into here is how does the government determine the value of your estate and the estate tax process? Craig, let's jump into number one here, is determining the gross value of the estate. And let's talk about your home and real estate for a minute there. What do we got to know about?
Well, it's the absolute important thing to remember is that we're starting with the gross value of the estate. Just the basic value of everything on the date that mom or dad or grandpa or grandma passed away. The government wants to know what's the value of those assets. So for example, the real estate, the home they lived in, they're going to be looking for an actual valuation. Now, you might be able to get away with, basic Zillow search, things like that. However, in some situations, like a really hot real estate market, like Southern California, for example, or large metro areas, they're going to they want an official appraisal, especially if it's a high value asset.
Craig, is it the gross value of the property they're looking for,
Yes.
When they're looking at that?
Yeah, they're starting right at the very beginning. Everything is just gross numbers. We're not subtracting any debts, any mortgages, or anything. They just want to know how much is that home worth, how much is your business worth, and whatever it might be, just the flat value of that asset.
And so they're going to audit your estate. So they audit every estate, the government, and this is a questionnaire that they send you to fill out, and you've got to get back to the IRS, correct?
Yeah, the almighty IRS Form 706, the estate tax form, and you also have to find an accountant who's familiar with processing an estate tax return. It's not always easy, but yes, you do have to fill out basically an estate tax list, the gross value of all the various assets in the estate as the first step.
Okay, so we get in, so the residence is a big one. You may have to hire an auditor, appraiser there.
An appraiser, yeah.
Appraiser, yeah. And then the business interest, talk a little bit about that. What do we need to know about business interest there?
Well, that's a really good one, Paul, because there's, let's say, two different types of businesses, for example. Let's say you have a sole proprietorship where most of the value of that business unfortunately died with the owner. That owner operator was the real value of the business. So there's not much value in the business itself, aside from some miscellaneous assets, for example. And then you have a corporation, for example, an S corporation or a C corp or a limited liability company. Those may actually have some pretty significant valuations on the balance sheet. For example, the company had reported a balance sheet value of X. Well, that value might not be accurate, having lost the CEO. So this is a situation, Paul, sometimes where the business valuation might look very high in the eyes of the auditor, the IRS, and it might be beneficial for the family to hire a professional business valuation firm to
Interesting.
show a lower value.
Okay.
Yeah, so
Okay.
that's an important item. The nuance, stocks and bonds and things like that, it's just simply a statement value on the date of someone's death. But a business valuation can be a substantial difference between what the government wants to say it's worth and what it's actually worth in the eyes of an appraiser.
Got it. And retirement accounts, anything to know there?
Not really. That's
Yeah.
just, again, it's a statement value
Okay.
unless you have a self-directed retirement account. So we have lots of clients who have self-directed retirement accounts that are invested in real estate, and those valuations are not always just simply pull a Zillow report.
Right.
Sometimes the auditor, the IRS wants to see an actual valuation for those properties inside that retirement account.
Got it. Okay. All right, let's get to life insurance. I know there's some interesting nuance there. What do we got to know there?
That's a huge one. We see so many eyes just explode just thinking when they hear this, that you might be, responsible parent and you've got $2-3 million of life insurance and that's for your family. Well, ultimately, that life insurance death benefit, if it pays into the estate, it will become part of the gross estate calculation.
Oh,
So
okay.
if $2 million of life insurance pays in all of a sudden, that actually becomes part of the estate tax calculation. Now, that can be corrected with some advanced estate planning, a little bit more advanced estate planning with things like life insurance trusts and family trusts that can keep that life insurance out of the estate. That can be done. But in general, most people are unaware that their life insurance death benefit gets included in their estate.
Interesting, because I've heard you and our attorneys and others at the firm talk about the life insurance piece and having the irrevocable life insurance trust around it,
Yeah, that's
which
a good point.
gets it out of the estate for estate tax purposes, but also protects cash value life insurance from the claims of creditors. People don't realize
Absolutely.
that, yeah,
Yeah.
creditors attack life insurance all the time.
Here in California, for example, life insurance cash values are not very well protected. Now, there's some states that have some very nice asset protection around life insurance, but California and many other states do not. And things like irrevocable life insurance trusts, certain LLC arrangements, various charitable arrangements are ways to build walls or speed bumps around life insurance values to protect them. But in general, basic life insurance death benefit ends up getting included in the gross estate.
Yeah, and then on the home, the personal home, Craig, I know there's strategies the firm talks about, kind of freezing techniques, freezing the value of the home, getting it out of the state, with tools such as QPERTs, qualified
Yep,
personal residence trust and
absolutely.
others. Yeah, true. Yeah.
Again, a little bit of advanced
Yeah.
estate planning that goes with a good quality, solid living trust and your wills and such can take your average. So that happens in metro areas these days, California being a primary, that the average 3-bedroom, 2-bath house could be $1.7 million nowadays. And if the estate tax becomes an issue again, all of a sudden that could be a pretty big item. How do we take care of that? There are some advanced estate planning techniques that can be done to move that asset out of the taxable estate.
Got it. Okay, so now we're going over to subtract the deductions. What do we need to know about here, passing assets to a surviving spouse and so forth? What's the process look like?
Yeah, that's actually a really good first point, is that if you leave a surviving spouse behind, there are no estate taxes to worry about because the estate can go directly to the surviving spouse. There's no estate tax paid on that first death, right? Now, there are some nuances to that. If this is a blended family situation, so we won't go into depth on that, but let's just say that we've got 2 spouses and one passes away. The one left behind takes over the estate. There's no estate tax, right? So that would automatically wipe out any estate tax issue because we take the gross estate and we take the amount passed to the spouse and they net each other out. So there's no estate tax there. It's really the first place that we start looking is what are the debts to the estate? What's the mortgage on the real estate, right? So whatever the value of that real estate is, we subtract the value of that mortgage that's still owed, and that brings down the taxable estate value based on mortgages, right?
Right.
The one that a lot of people miss, though, is that, and we hope that our clients and we hope that everybody watching this hears this carefully, that if you haven't done your estate plan, your living trust, your wills, and done all that, the value of probate expenses, right? The cost, let's say, it's not a value, it's a cost. The cost of probate, lawyers, and fees, that is deducted from the gross estate, right? So you could spend nowadays $20,000, $30,000 on probate costs. That is deducted from the gross estate in calculating estate taxes.
Yeah, no, the probate issue is a big one because if you have a will only, does not allow you to avoid probate.
No.
It's having the living revocable trust that
Right.
gets you out of probate. But yeah, probate, depending on your state, again, can is expensive, can take years. We've had probates that go on for years. So
oh yeah, the
it's
average
a big deal.
probate in California is 18 months. A complicated probate with property in 2 states could take 2 years or more.
And that's a good point, because if you've got assets in different states, it's probated in each state where you have that. That
is absolutely accurate. I met someone recently. Thankfully, nothing has happened. It was a question about an estate plan, and they have 3 different properties, 3 different states. And they did not realize that it wasn't just probate in their home state of Florida. It was probate in the Tucson area in Arizona, and then probate in Maine, right? So they would have, their family would have to open probate in 3 states if they didn't have their revocable living trust in process. So the probate expenses come out of the gross estate. And another way to reduce the value of the gross estate is just to throw, mom or dad or grandma or grandpa a gigantic funeral, because the cost of the funeral and burial expenses is also reduces the gross estate.
Yeah. Okay.
Right.
And then charities, obviously there's advanced charitable strategies that clients get involved in.
Yeah, we do that actually. That's something that our attorneys have conversations about frequently. Probably the most famous case in estate planning lore is the former First Lady, Jacqueline Onassis Kennedy, that she had a testamentary provision in her estate plan that gave a large amount of money to charity when she passed away. And it reduced the value of her taxable estate. So very big reduction in estate taxes. So charitable planning in the estate plan is a big one. Absolutely.
Yeah. And I know we're not going to go into it here, Craig, but I know a charitable strategy firm talks about is, like you just said, is having assets go to a charity through some charitable tool. And then the idea always comes up, well, what about the beneficiaries, the children who may lose out? You want to create a legacy. And this is where life insurance comes in to replace the value of the assets given to charity. So life insurance kicks in as a beneficiary benefit, in that equation.
Yeah, there's a lot there, and you're right. That's a deep conversation.
Right.
But to say that the estate tax is reduced by charitable gifting, absolutely. How do we do that without disinheriting our children, right? There's some planning around that as well. Really cool conversation that we'd love to have.
Okay. Now, calculating the tax. So maybe, this gets into, what is the tax? And I know, that's a moving target, is that the estate tax situation.
It is absolutely a moving target.
All over the map, yeah.
Yeah, and what we'll say with this, and what we always say is, you really do need a good accountant who understands how to process the estate tax return, how to calculate, And we generally don't cross into that CPA or accountant line, that enrolled agent line, because it is a moving target. A good rule of thumb, though, is that the estate tax, whatever amount is going to be subject to estate tax, somewhere in the neighborhood of 40 to 50+% tax. It's a lot.
Yeah.
It's almost a punitive tax, right? So it's
And it's
basically
changing, and it's changing
all the
too,
time.
because yeah, I mean,
Yeah.
well, the estate tax is going to change. So those Trump era taxes that
Yep.
he put in there, they're going away, and there's uh there's some content on the calendar right now from the current administration to lower the estate tax even more. So
Right.
it's in
Right.
flux.
It is a moving target. What our attorneys will generally say is that the best time to engage in this type of planning is yesterday.
Right.
Right? Do
Right.
it now. Well, some will say, well, I don't have an estate tax issue today. Not today. If you plan for it and you put it in place, your family may never have an estate tax issue, right? That's why we always will have the conversation around what it takes to address these things. But the tax is the tax. The accountants will help figure that out. The real big deal, though, is ultimately making sure that you have that tax advice, looking for the appropriate credits in your estate plan, what offsets do you have, charitable gifting, etc. But then you've got to pay the tax.
Right.
Now, I like to clarify in these conversations, Paul, and you've heard me say this before, you don't pay the tax because you're up in heaven learning to play the harp, right? You're not paying the tax, it's your kids, right, that have to pay the tax. And the tax is due, whatever the amount is, in 9 months after your death.
Right.
Which, in the grand scheme of things, I mean, 9 months is a blink of an eye. It goes
Right.
by very quickly in the hurricane of stuff that you have to do to settle up an estate and selling properties and things like that. So the big deal here that I think we probably want to hit on is, how will your kids pay the tax? Right? Let's say that it's not a giant tax. Let's say that it's a $200,000 or $300,000 estate tax. Well, unless you have $200,000 or $300,000 in cash ready to pay the estate tax, what will the kids have to sell in order to pay the tax?
Right.
So, for example, you might have 3 rental properties and an S corporation business. That's where the bulk of your estate value was. Or maybe some retirement accounts that are taxable. Well, if the kids now have to pay a $300,000 estate tax, will they have to liquidate a retirement account and take a huge tax penalty to do so, to pay the tax? Will they have to sell a piece of real estate regardless of what the market is at that time?
Right.
Right? It puts a lot of pressure on the kids if you don't actually have a plan, if there's no life insurance, or if there's no plan to be ready to pay the tax. They're forced into a, kind of an urgent situation where they have to make a decision that might not be the best at the time.
Yeah, we see this a lot with investment property owners. We work with a lot of folks that own
Right.
rental properties, whether it's one or many, and we just see too often that families would love to leave a legacy for the next generation, and a lot of times their kids are involved in the rental property business with them, and it's a retirement income in a lot of cases for the people that own investment property.
Yeah.
And then it's just blowing up when someone passes away due to proper planning or no planning.
Or no planning, right.
Yeah, so just as a reminder, if you're in that space, really important to understand what you can do to protect your family legacy.
No, absolutely. That's a really good point. That we see this all too often, that the planning affects, the lack of planning affects those left behind. We're blessed to see the other side where we have really good planning and we're able to help that next or second or third generation transfer assets easily. The process is smooth, taxes are low, it all works out great. We've also seen it many times where we've had to help folks through the situation where I'll never forget, Paul, the first time I actually had to tell the kids when, mom passed, that it looks like you're likely just going to have to sell these 2 houses.
Right.
And
right.
because they didn't have the money to pay the tax.
Right. I want to share my screen now before I forget here.
Yeah, please. That's a good one. Definitely don't miss this one.
Yeah. So if you want to get, you can see this, Craig, up here.
Yes, absolutely. Guard assets.
Yeah. If you want to get one-on-one with us for any questions you have with Craig and the attorneys, looking at your planning, again, whether it's a small issue, a larger issue, maybe you don't have any planning in place and you want to figure out, what do I do to get a living trust and a will? How do those go together? There's medical directives, there's a financial power of attorneys, all those things that go into your estate plan, because we've all got an estate.
Yeah.
Get with us one-on-one, text guard assets to that phone number. That's a quick intake call. You'll talk with me. We'll figure out what are your hot button issues and get you connected for a complimentary assessment where we give you input. You walk away with our observations, recommendations that says, okay, here's your planning. Here's what you can do. Here's some great opportunities. And you get that. So text guard assets to that number. And keep watching for emails, because we do these live shows every single week to just bring you more information. And we're really trying to isolate hot button issues that impact you and hope to help you along the way in some fashion. Craig, I want to say thanks for being here. Great to have you. Thank you, everybody. And look forward to speaking to each and every one of you with any help that you might need. Thanks, Craig.
You got it. Take care, Paul.
All right. We'll see you
Bye,
next
everybody.
time.